You're a good soldier, choosing your battles. Pick yourself up and dust yourself off and back in the saddle. You're on the front line, everyone's watching. You know it's serious, we're getting closer, this isn't over. The pressure's on, you feel it, but you got it all, believe it. When you fall, get up, oh, oh, and if you fall, get up, eh, eh. Samina, mina, sangalewa, cause this is Africa. Samina, mina, eh, eh, waka, waka, eh, eh. Samina, mina, sangalewa, this time for Africa. Listen to your God, this is our motto. Your time to shine, don't wait in line, y vamos por todo. People are raising their expectations. Go on and feed them, this is your moment, no hesitation. Today's your day, I feel it. You pave the way, believe it. If you get down, get up, oh, oh. When you get down, get up, eh, eh. Samina, mina, sangalewa, this time for Africa. Samina, mina, eh, eh. Waka, waka, eh, eh. Samina, mina, sangalewa, anawa, ah, ah. Samina, mina, eh, eh. Waka, waka, eh, eh. Samina, mina, sangalewa, this time for Africa.
I'm well on my journey, biggie, biggie mama, what A to Z. My sister's on my journey, biggie, biggie mama, from east to west. Party, waka, waka, my eh, eh. Waka, waka, my eh, eh. Sangin' so mazibu, yeah. Cause this is Africa.
Switching on a light shouldn't be this complex. Neither should choosing where to invest your money. With Cinnabar Investment Management, we take the complexity out of investing, ensuring the right fund for the right investor every time. Cinnabar Investment Management. Complexity simplified.
Good morning, everyone. Thanks so much for joining us on this beautiful, beautiful spring day. There you go. You should be seeing more than just me now. You should be seeing the screen. I'd like to just, first of all, thank everyone for being here. Thank you for joining us on our third quarter report back. I'd also like to thank you for sharing this content with people you care about, with your friends, because we've seen a massive increase in people that have registered. In the first quarter, we had about 200 people registering. The second quarter, 400. And this quarter, just amazed to say that we have 800 people rather, 800 people that have registered. It's actually quite astounding. We've got an incredible lineup today. We hope it's going to be very, very useful. Please feel free to share with as many people as you wish to. If you'd like to send a link while you're watching, also feel free to do that. We're going to be recording the entire session, and we're going to be posting it onto our YouTube channel. So if you missed it, or you have to leave it early for whatever reason, you can always go back and watch it there, and you can share it with friends on the YouTube link. So let's go through what the agenda looks like for today. And I'm going to start off by giving you a brief business update as to what's been happening within Cinnabar over the past quarter. Then Cameron Hewson is going to take us on a market review and give us some investment insights. Geoff Blount is going to take us through the Cinnabar performance and how Cinnabar is right now positioned from a portfolio perspective. And then Mmusi Maimane is joining us, and he's going to be taking us through the challenges and opportunities for South Africa. As always, please post as many questions as you can in the chat. Whatever comes to mind, pop in there. We're going to see if we're going to get to every question. We've allocated a lot of time to Q&A today, so we're hoping that it's going to be a really rich conversation at the end of the presentation. So just to remind us, our purpose, this is Cinnabar's purpose, is to create and protect intergenerational wealth. And I thought it's important to highlight why this is so important. When there is intergenerational wealth that exists within a family unit, it frees up future generations to live their impactful purpose. They're not constrained by having to do something that they do not want to be doing. They might be free to drive towards a purpose that ends up having a far bigger impact on the world than doing something just to earn money. So I know we all have to earn money, but hopefully it's our purpose as well as earning the money. Our core values, we look to invest our effort for value. So this is really talks to where we spend our energy. We spend our energy in delivering value to our clients and to the business. If we're not delivering value to you or the business, then we avoid doing it. We always aim to be to challenge, but not to be disagreeable. So within our investment committee meetings, they often appear to be very heated. And the debates are rigorous, but we don't play the man. We do our very best to always play the ball to get to the best outcomes for the portfolios and in turn for your returns. We try and make everything very simple. So in the investment world, it is very easy to make things complex. And what we try and do is make things really, really simple, where everything is packaged into a few portfolios where there's a lot of complexity behind it, but on the surface, it's fairly simple and gives predictable returns. We have an absolute hunger for growth in everything we do. That's both for our clients, for ourselves, and certainly for South Africa. And then this is probably one of the most important ones, is that we have the luxury of approaching investments completely independently. We're not owned by any large asset management company. We're not owned by any large life insurance company, which means that we're not obliged to use anyone. We can use whoever we feel is best within the portfolios when we construct them. The Cinnabar ecosystem that we've built over the past while is proving to add more value to more people. Now, what you'll notice within the ecosystem isn't investment returns. We regard that as a default. There are a lot of asset managers out there that they give fairly predictable returns. So we regard that as a given, that we must give you. And the core offering to advisors that use Cinnabar is that we look to help them double their profit within a year. We then give them access to cutting-edge technology in the form of WealthBit, and this is used to help advise their clients and put their clients' plan into their clients' hands. So back in the day, the way the financial advisory system used to work is the advisor would have the plan and they would then tell their clients what they should be doing. We don't feel that's the right approach. We rather put a plan into the client's hands and help our clients understand what their plan looks like, where at best case scenario, the clients are then suggesting to the advisor what should be done within their portfolio. So we use the data that comes from WealthBit to create a normalized data set, which then produces something called the book risk analyzer. And this book risk analyzer is really useful because it shows every single client that is either under risked or over risked. In other words, are they taking not enough risk and they're not going to get enough return, or are they taking too much risk where they may lose more than they expect to lose if the market goes backwards. So this is a core component within our offering, and it helps get more people towards financial freedom. And then many clients, many of our wealth managers, they use the Cinnabar team to help package the solutions for clients and provide support to those wealth managers, so that the wealth managers can spend more time with their clients rather than doing legwork in the back office. And then for advisors who are looking to exit the profession, we provide succession solutions so that there's continuity from their client's perspective. So that's our ecosystem. It's proving to be quite effective. We've had tremendous growth over the past quarter. We've grown our assets by around 25% in the quarter. So we've gone up by an enormous amount in one quarter. So well done to the team, and it looks like something we are doing is adding real value to everyone we're serving. We've also signed 3 new partnership agreements with 3 financial advisory firms. So we welcome them on board. Thank you for joining us, and we hope we're going to add tremendous value to your firms over the coming years. And then, very excitingly, we have finally launched that global equity fund that we've been talking about for a while. It's off to a very good start in a tough period. So when you launch a fund, you ideally want the markets to fall, because if you launch a fund and the markets fall and you're predominantly in cash at the time, then you look relatively good to peers. And that hasn't been the case. So we've been in a rising market, which is the most difficult time to launch a fund, but the team has implemented the fund very, very well, and you'll see the results of that a bit later. So again, thanks for joining us. I hope you're going to really enjoy this quarterly session. Cam, I'm going to hand over to you if you'll take us through 2024, a year of uncertainty, change, and global impact. I'm going to stop sharing. I'm going to leave it up to you, Cam.
Thank you, Alex. Thank you. Cool. Coming through clearly, yeah?
Perfectly.
Perfect. Now that is awesome. I'm testing out this new microphone, so I'm hoping it pays dividends. But yeah, I mean, Alex has touched on it already. It's been such an incredible year. I mean, there's been a whirlwind of events that have happened this year. There's been, honestly, so many events that literally nobody could have predicted that we've had. We've had sporting victories throughout the world that have kind of brought nations together. We've had central banks trying to fight this stubborn thing called inflation. But it's been a year full of ups and downs, and it hasn't just stopped there. We've noticed that there's been some geopolitical tensions that have arisen. Unfortunately, the war in Ukraine still carries on, and the renewed tensions in the Middle East also add a layer of complexity to the global market. And if that wasn't enough, the US went and had back-to-back hurricanes just to top it all off that ran rampant through parts of Florida, causing further disruptions and uncertainty. But now, all of these factors alone would have made 2024 quite memorable. I'm sure you all agree. But what set 2024 apart and why it will be so pivotal for the next couple of years is that over half the world's population went to the polls this year. So major elections took place across all the several continents, and the outcomes of these elections will likely shape global economic and the political landscape for some years to come. The year has been so pivotal, and the after effects of these elections probably aren't going to be fully understood for some time. But what it all seems to be building up to is some kind of climax, and that being arguably the biggest election of them all, the US presidential election, where stakes literally could not be any higher. So the US election has also had its fair share of volatility, as I'm sure we're all aware of. There's been numerous unexpected twists that have kept the world on edge. But taking it back to the start, it began with a familiar rivalry, Donald Trump versus President Joe Biden, who, although most might not know this, he's still actually the president, even though he's kind of faded away from the spotlight. As we all know, in a surprising turn of events, President Joe Biden withdrew from the race, citing reasons like he had health issues. Although it was clear already at this point that he had lost the backing of his Democratic Party. So what was left is for the Democratic Democratic Party, they had to rally behind Kamala Harris. Meanwhile, stakes were even raised further after a shocking assassination attempt on Donald Trump. Just showed that it's a stark reminder of how important, how intense, and how critical this election has now become. Going through to today, and we see that much throughout like the rest of this the campaign race, it's an incredibly tight, fiercely competitive race between Harris and Trump, with momentum swinging from blue to red almost on a weekly basis. It's really just the contest has captured the entire world and in the US as well. The volatility we're seeing here in this election not only mirrors also mirrors the unpredictability that we've seen across the year with regards to economic shifts, geopolitical tensions, and then even natural disasters. But as we approach the final stretch, we're now just 12 days away from the US election. One thing is for certain, and that is that this race is far from over, and the outcome will have significant implications. So let's just imagine Donald Trump were to win. What would we be seeing? Well, more continuation of his previous policies when he was a president. So you'll see a tougher stance on international trade, so likely to see a lot more tariffs, some more deregulation, and then an overall conservative approach to socioeconomic issues. Were Kamala to win, on the other hand, you are likely to see a more progressive economic policy, some more potential reforms with regards to healthcare and climate, and then a shift in international relations. But either way, the outcome of this election will set the tone for US policy and global market dynamics for years to come, making this election probably one of the most consequential in recent history. So the US election was one of the battles fought by inside the US. The second one was by the Federal Reserve. So the Federal Reserve have been battling to keep inflation under control. After a sharp rise in prices in 2022 and early 2023, inflation became the primary concern for the Federal Reserve. And so as a result, what they had to do was to make sure that inflation didn't get out of hand. They kept interest rates higher for longer, which ended up putting a bit of stress on the consumer, but not as much as initially expected. But we'll touch on that in a sec. But as we can see here, looking at the blue line headline and CPI, and the gray line is core, which core CPI is just headline, but you take out the more volatile energy sectors, which is food and energy. But what we can see is that over the past year, inflation has started to come down, largely helped by energy prices. They've helped cool overall pressures on inflation. So looking ahead, this trend in inflation is likely to continue into 2025. There's some real-time data combined with some broader disinflationary trends evident in the US, like stable supply chains and then easing wage pressures as well. It all suggests that inflation could come back to the Fed's 2% target by the end of this year. With inflation now somewhat under control, the Federal Reserve could switch to their second part of their dual mandate, which is to protect employment. In September, they joined other global central banks by cutting rates by 50 basis points. Further rate cuts on the back of this are going to be possible, and the size of which will also largely depend on the economic data that is to come in. However, with the easing measures, rates are likely to settle at structurally higher levels than they have been for the past decade. Unless, of course, there are any kind of external major economic shocks. But overall, the Fed has done well. They've managed to keep the labor market healthy, and there's been a steady job growth over the past quarters, and that's expected to continue. So the stability in the job market, as well as the Fed's supportive actions, means that consumers will likely remain confident, employed, and the best part that drives economic resilience, they're going to be ready to spend. We can see this when we have a look at the real GDP, which is how much a country grows by just adjusted for inflation. And what we can see is that outside of periods like the 2008 Great Financial Crisis, where the US economy entered a recession, and then during COVID, we can see that the US tends to grow at around 2.1%. And despite the headwinds of these high interest rates and the sticky inflation that the US has had to deal with over this period, so has the rest of the world, but specifically the US has still continued to power on. Beating most economists' expectations, they have managed to maintain a solid growth pace this year, fueled by the resilient consumer. Moving forward, what we expect is that the resilient consumer will continue to support this trend-like growth for the US economy well into 2025. And with few excesses building across the more cyclical sectors of the US economy, we're expecting that a near-term recession is unlikely. But I must caveat that by saying that with the upcoming election, crucial monetary policy decisions by the Fed, and the persistent geopolitical tensions that do exist, external risks could still lead to a mild economic recession. So as you can see, the US market has done fantastically. GDP growth has been great. Labor market seems to be incredibly strong. And what that's meant is that US equities have continued to soar. So since early 2023, US stocks have returned over 50%. But most importantly, is if you take the top 10 stocks out of the S&P 500, which are the largest 500 companies in the US, you take those top 10 out, the market return drops down to 20%. So from 50 to 20% just by taking out the top 10. Shows how much the performance of these top 10 companies has actually driven the performance of the entire market. The top right graph here shows just the weight of these top 10 stocks in the total S&P 500. So they're 10 out of 500, but yet they make up over a third of the entire market weighting. So this means that their share of the market is greater than ever, making future returns largely dependent on the performance of these stocks. So in simple terms, passive funds become more dependent on the success of a few big companies, which makes them less diversified and more vulnerable to swings in the performance of those top stocks. This does raise the case for active managers. We'll touch on that in a sec, but I think that this is it's providing quite a good backdrop to switch out of the passive instruments like your ETFs and potentially move into the more active manager approaches where they can hopefully earn their higher fees. The left graph points out that these top 10 stocks have relatively high valuations. So what you can see is that relative to average, the top 10, the rest of the 490 and the overall market is overextended. I mean, they're way above average. The top 10 are significantly so. But what this is saying is that if there's any kind of earnings slump in these top 10 stocks, the entire market is likely to pull back as well, and the passive funds would then be negatively affected. But that said, the top 10 stocks in the S&P 500 are there for a reason. They have built up significant competitive advantages. And as we can see by their spending, 41% of their spending is going into research and development. So they aren't just resting on their laurels and accepting what they've got now is the best and that nobody's going to catch them. They are spending almost half of their expenses to further their competitive advantage, to continue building out this moat so that they will continue to perform into the future. But there is still a base case of concentration risk in the S&P 500. But the good news is that the broadening out of the market has already begun. The rest of the 490 stocks and the businesses that make up those stocks are starting to show some positive earnings growth at the moment. If economic growth does stay steady, the trend could continue throughout the rest of the year. And in this environment, it would be a key time for active managers because they have the ability to take the money that's invested into these top 10 stocks that make up most of the S&P 500 and allocate those to opportunities where there are more promising returns on hand, at least. So in your small and your mid-cap companies. You would never remove the inclusion of these top 10 stocks because they are there for a reason. Like we've touched on, they are more likely to grow than not. But you've got to make sure that you limit the downside risk. So that's exactly what we've been doing at Cinnabar, is making sure that we are allocating to these managers, but to make sure that they aren't too overweight these top 10 stocks. We're making an active approach to reduce the risk and try to build more balanced and diversified portfolios. The global economy, largely as a whole, has been incredibly resilient as well, performing better than many would have expected. There have been a few areas of weakness, however, but beyond the US, emerging markets have been very strong, other than China, though. I'll touch on them now in a sec, but Europe as a whole has faced significant challenges, particularly in the manufacturing-heavy economies like Germany, which is Europe's largest economy. They have struggled with the high energy costs as well as increasing competition coming from the likes of China. They've created and also highlighted some of the structural issues in the way that the German economy is operating at the moment. But still, There has been strength in the more service-oriented sectors found in Southern Europe, with the likes of Italy and Spain, where they've helped kind of alleviate and offset some of the pressures felt by the overall European economy. Moving forward, the further rate cuts from the European Central Bank could ease lending conditions, which would support businesses and consumers and could foster some more economic productivity out of this region. In China, they are still struggling and are hampered by a real estate slump. And then the consumers have showing very weak demand. They're not willing to spend at the moment. They're saving a lot. And that has kind of hurt their market. But there is fresh optimism with through some government initiatives and their recently announced stimulus plans, which will help, hopefully, to stabilize the economy to grow at around 5%. Yet, elsewhere in Asia, other stocks or other countries have also benefited. The likes of Taiwan and Korea have caught this kind of run up again in this tech-centric momentum around the electronic sector and AI integration. So that's kind of pushed that market forward quite a bit. And then India as well is also still continuing its growth trajectory. It's being sustained, this growth trajectory, by very favorable demographics. So they got cheap cost of labor, but also so much employment there, and then some supportive business policies. But I think it's best if we start bringing this back home, because what a year it has been so far. Hope and excitement has been reignited across our country yet again. We have seen heroes emerge, like our beloved Booker bringing home the rugby championship, Tatiana Smith winning 2 medals, one of them being gold at the Olympics, and even our dearly beloved Eskom managing to keep the lights on now for over 200 days. These are moments that have so far reminded us of our strength and, more importantly, our resilience and our ability to shine even on the global stage. But of course, not everything has gone our way. Our Proteas, both men and more recently the women, managed to fall just short and came so heartbreakingly close to bringing back the T20 World Cup trophy. Let's hope this metaphor of so close yet so far isn't a metaphor for the rest of South Africa, because I think it's vital to remember where we were just about 6 months ago. Back then, South African pessimism was at an all-time high. The world had literally bet against us and the outlook felt very uncertain. After the first 2 months alone, the JSE had already gone down 5.5%, and South Africa nearly went into a recession, only escaping by 0.1%. The sense of gloom was palpable and confidence was incredibly low. Yet, what followed was nothing short of spectacular. What we've seen is the JSE, the All-Share Index, soaring this year. South African equities have soared. They've outpaced even some of the, most of the global, major global market indices. If we look year to date, the South African JSE in dollar terms has returned 31.8%. Its closest market was the US, which did 23.4%, but significant outperformance on the back of this newfound optimism and these structural reforms. September again brought some more further encouraging signs, with some of the key economic indicators catching up to this newfound optimism. We saw inflation ease, we saw manufacturing increase, and the economy actually managed to grow by 0.4% quarter on quarter in Q2, supported by Eskom's new generational operational recovery plan. And as we know, having consistent power supply is crucial for economic stability, but also economic growth. And the impacts and what they've started doing with the Eskom power creation facilities are starting to pay real dividends now. There were a few key other drivers happened more recently, including policy easing from the US and South Africa, alongside the progress made by the Governor of National Unity. So they've implemented a few market-friendly reforms that have continued to boost the South African equity market. There've also been, as we touched on earlier, new stimulus measures coming out of China, where they're trying to revive their property market and the entire market as a whole. This new stimulus measure kind of boosted the risk on sentiment, which further pushed the JSE higher, making it reach new highs. Together, these factors have created an environment of more optimistic growth that should continue into the future as long as we continue to deliver on our reforms. But it's not just been SA equities that have been flying. SA assets as a whole have benefited from the optimism and in these catalysts for growth. Over the past 12 months, SA bonds and listed property have shone, delivering impressive returns and then significantly outperforming inflation. The All Bond Index, reflected here in green, has returned 26% over a one-year period, reflecting and driven by this positive investor sentiment. But the real star of the show this year so far has been the returns of SA listed property, a far underperforming asset class for the past 10 years. They've returned over 51% over the year. The sharp rise in this performance, I mean, it's largely attributed to the renewed confidence in the property sector, but also businesses and consumers starting to get more comfortable and starting to adjust to the stable economic environment in which we are starting to get towards. But by comparison, if we look at cash is here shown in blue by Steffi Call Deposit, returned around 8% over a one-year period. It's kind of reflecting the low risk return nature of cash, but also highlights the importance of diversification. To stick in cash, because if we remember back here, the outlook was very, very bland and very gloomy. To stick in cash, this is what you miss out on, and just shows the importance of diversifying outside of cash, especially in a period where both listed property, equity, and all bonds have run. On the back of a lot of this optimism and the notable shift in sentiment around South Africa, along with this new risk-on environment, the rand has surged. This time last year, we were sitting at 19.51 rand to the dollar. Quite high levels, peak pessimism from global markets and even us South Africans were beat down a bit. But by August, we had seen the changes happen and we've been brought down back to 17.80, going through that 18 rand to the dollar barrier. Then touched on again, the stimulus provided by Japan or by China has meant that we have pushed down, almost breaking through the 17 rand to the dollar barrier. But as you can see, the rand has given back some of its early strength. There is some doubts around how committed China is to recovery, to supplying the necessary stimulus in order to bring back their economy. But despite this pullback, the rand remains in a significantly stronger position than we were just a year ago. Looking ahead, there's hope that the continued positive sentiment, as well as some of the structural reforms, will help push the rand lower, stronger, and push it through that 17 rand to the dollar barrier, hopefully within the year and then into 2025. And so what I want to leave you with is South Africa is at arguably one of its most pivotal moments since 1994, where the formation of the Government of National Unity, with the formation of the Government of National Unity, there is a real opportunity for the country to chart a new path forward. If the GNU can work effectively together and deliver on the promises it's been making, it could lead South Africa into a golden era of growth and prosperity. However, it is important to note and acknowledge that there are challenges ahead. We've already seen a few cracks start to form with Celia's Brink's removal from Mayor of Tshwane, as well as some varying opinions on the, within the coalition on the NHI bill. I, for one, cannot wait for our guest speaker, Mmusi Maimane, to give us a first-hand experience as to how effective the GNU has been, but importantly, how effective the GNU can be. But before this, given all of the uncertainty and the volatility in the markets, it's essential that we at Cinnabar stay true to our investment philosophy. We must avoid getting caught up in the hysteria of the moment and focus on making decisions that benefit our clients and ensure that we make and deliver on our purpose, which is to create intergenerational wealth for our clients. That's why we've made small strategic adjustments to the portfolio, but making sure to maintain a steady long-term approach. But I won't go into too much detail. I'll hand it over to Geoff, and he can take us into more details about how we've made these adjustments and how the portfolios have performed. Thank you, Geoff.
Thanks, Cameron. Hello, everyone. Cameron's going to drive the deck like he normally does when I talk. I'm going to begin the first sort of 5 or 6 slides reminding you again of our investment approach and our philosophy. And I'm going to do this every single time we feed back to our clients and partners, because we need to remind you of our approach to investing, but B, importantly, this acts as an internal reference point to us that we can check ourselves against and offer strategic guidance into how we operate and manage our clients and your money. So how do we believe that we outperform over time, and what do we try and do? Well, in fact, we try and be incredibly boring. We always start with us saying, look, let's win by not losing. So one of the first things you want to do is to make sure that it's not always about backing the winners, because that leads to underperformance. But if you back the losers, you can potentially lose your capital, and you can never really recover from that. It's incredibly difficult to recover from that. So our starting point is let's win by not losing. How do we do that? Well, the first one is we want to make sure that we don't have any unintended bets or single factor bets in our portfolio and portfolios. You could build a wonderfully diversified portfolio of shares on the JSE, but if they were all dependent on the direction of the rand, it means that despite your diversification at the security level, you actually have a single factor bet, and that's just that you've taken one bet or one position on the direction of the currency. Well, this could happen with interest rates. It could happen with the commodity cycle. It could happen on the outcome of the US election. And so we want to avoid anything that there could be an unintended consequence from the positioning that we take in. Normally, it's quite easy to identify what the single factor bets are if your portfolio is directly aligned with a view on a currency or an interest rate. But sometimes it's quite hard to see where you have this unintended consequence that through all of your manager selection, in our case, and their stock and security selection, the portfolio ends up in a direction that we didn't foresee. And if something goes wrong with that factor, obviously that can result in underperformance or loss for our clients. And how do we do that? Well, we diversify across both asset classes, across asset types, across managers, and then the securities in that. And we'll talk about that in a moment, again, the peeling of the onion. And then the next one is if you're not taking outsized bets anywhere along in the portfolio, what you're really trying to do is just to ensure that every year you're just trying to get a few things right. If you can get a few things right, more right every year than you get wrong, over time, that leads to long-term consistent outperformance. So in fact, it's incredibly boring. And I suspect in the next few report backs, maybe we're going to ask one of our clients or partners to actually talk through this, because you're going to get these slides every time. Okay, if we can move on then to the next slide. So while we talk about avoiding outsized bets, one of the other ways or unintended consequences, one of the ways that we box smart is try and benefit from the one free lunch that exists in the world of investing. We know that long-term returns, both empirically but also anecdotally through our experience, long-term returns for our clients and investors, more than 91% of those returns are determined by your strategic asset allocation. How much you've got in growth assets or defensive assets, how much you've got in property, bonds, cash, how much you have in rands or in different currencies. That's your strategic reference point and your starting point with which we build the portfolios. And later on, Alex is going to show you what we call the funnel of certainty, where he talks about how important the strategic asset allocation is from achieving, or you'll demonstrate that in terms of the returns that our clients enjoy. So if you get your strategic asset allocation right when building portfolios for clients or our clients, you've won 90% of the battle. And then the funny part is that only 9% or 8.5% of extra value add comes from security selection, what stocks that you own, asset class tilts, going from one asset class to another, and other sources of return. So the funny part is that when we report back to our clients on the returns, the stuff that we can influence once we've set your strategic asset allocation is actually the stuff in gray. And we can only really influence about 9% of the long-term outcomes. But it's very important how we manage that 9%, and hence the reference to our philosophy and viewpoint in the market. So we start off then, Cam, if we start off with our starting point to get our asset allocation right, we see the world quite simply. We think that there are really two types of asset classes, but technically you could add a third one. The one is what we call defensive asset classes. So these are asset classes, typically fixed income, bonds, money in the bank, etc., where your returns are lower, but your capital risk is reduced. These are income-focused type assets. You then get your growth assets. Your growth assets would be equities is the obvious one. Properties would be another one, which properties have a bit of yield, but they also have the ability to grow in capital. And then we got what we call flexible assets. Those are kind of mandates where the investment managers can do interesting or different things in the portfolio. They can also change their weighting to different asset classes. So as you're aware, then in the way we see the world, as you move from your more conservative funds, where you're just trying to get income, protect your capital, you're going to have a full allocation to your defensive assets. If you go all the way through to our more aggressive portfolios, where we're really trying to grow capital, you're going to have a greater allocation to your growth assets, but it comes with volatility, and you'll put some flexible and defensive assets in that. And it's the strategic asset allocation across these asset classes that determines your long-term inflation plus 3 or 4 or 5 or 6 or 7 return. And that, again, is what Alex is going to talk about in the funnels of certainty. So once we've started building those asset allocations, we then had to sort of peel back the onion, because you say, well, let's start off saying for a portfolio that's trying to achieve a certain return, how much in defensive and growth. But there's more to that. Then once we look at what's in defensive and growth, we have to unpack, well, what type of equities, what type of real assets, what type of fixed income, whether it's cash or bonds in the portfolio. We then go back to another layer of the onion is then within what type of assets we'll actually say what segments. So you might say, okay, well, within growth assets, we're going to have some, we've got equity, but which equities? What regions of equities? And then the fourth layer that we add on top of that is then the managers that will manage those mandates. And so, again, you can see here how we're trying to build this diversified approach, not taking excessive bets, no unintended consequences, trying to be slow and steady, trying to just get a few things right, more things right than we get wrong. And over time, that leads to outperformance. And that's how we construct the portfolios. So how's this rolled out? And again, I'm pleased to say that this is a very nice report back that we're doing on a performance update. Almost all our funds are firing on all cylinders across all time frames, and that's we're very excited by that. At the same time, I always say to our clients, there are going to be times when they come back, and sometimes they aren't going to do exactly as we behaved. So, but we'll take the good news and take the pat on the back for where we are at the moment, but caveating that we don't. That over time, not every report back we're going to give is going to be as a purple patch as this. So let's just start off with across the range of our portfolios. This is our fund performance in the various categories, red being the income fund. Oh, no, sorry, go back, Cameron. Sorry, red being the income fund, the green being the stable fund of funds, the dark blue being the balanced fund, the gray being the balanced fund plus. Our yellowy color, the mustard color, is the flexible fund, and then the light green is the worldwide flexible fund. And what we've done is we've mapped each of our funds versus the ACISA or the average unit trust out there in that particular category, and whether our funds have outperformed the average fund in that category or not. And we're pleased to say year to date, all our funds are outperforming their peers. 1 year, all our funds are outperforming the peers. Over 3 years, barring the one fund, we're slightly behind. We're ahead, and then obviously over 5 years, 4 of our 6 funds, we're very pleased are ahead of their peers. But remember, we're not actually ultimately building funds to outperform peers, because that's just to show that we're actually doing a good job in our selection and blending. Really, what we're trying to do is actually achieve the long-term benchmarks that we've set for you, the inflation plus 3, 5, 7 numbers. Nevertheless, let's unpack these a little bit more closely. We'll start off with the income fund. And so we're pleased to say that the income fund itself over time, that's in the red, we're pleased to say that it is now ahead of peers over all time frames. In fact, it's first quartile. In other words, it's in the top 25% of its peers over year-to-date 1 and 3 years, and then over 5 years, it's in second quartile. So it's above the top half. And that's both against its benchmark of inflation +1, but also what the peers have done. While we are quite pleased with this, is notwithstanding, is that while the long-term numbers are attractive, the fund did have our managers in the fund did have a little wobble in the last 3 to 6 months. 2 of our managers, Cameron, if you can go ahead, Saffron and MyPlan, had exposure to bridge finance. They had bought bonds or had essentially lent money to bridge finance. That was a company that's involved in the taxi funding industry, and unfortunately those investments have been impaired because bridge itself has run into problems. So what these managers have done is they've actually ring-fenced those assets. If there is a recoverability of those assets, obviously then those assets will come back into the fund. But Cameron, if you go to the next slide, notwithstanding the fact that even over 1 year, those managers have pulled us down, you can see that the MyPlan and Saffron manager over 3 years, and this includes the impact of the bridge investment. In fact, both those 2 managers are actually still ahead of the pack across the average manager in that space. And obviously PMX coming number 1 in that space. So we're pleased with this performance, notwithstanding the challenges that have come out of bridge finance. In terms of our other funds and how they've done, again, our Cinnabar stable fund over all time frames is in the top 25% of the peer universe. Our balanced fund over all time frames is in the top half, and in the last 3 years, it's in the top quarter. Cinnabar balanced over all time frames in the top half, and in the last 2 measurement periods, it's in the top 25%. So again, pleased with that performance. I must stop saying we're pleased with that performance because there are sometimes it's going to go wrong. Cameron, if we go to the next one, the flexible fund, which you'll see here again, also doing well. And then our worldwide flexible fund on the last 2 measurement periods in the top half. Over 3 and 5 years, it's in the third quartile, but that it just slips into the third quartile. And we think if the continued performance, continues, we'll see that the yellow will disappear off the slide in time. So that's just our performance in that space. As you're aware, a lot of the performance of our funds is dependent on, especially in the funds that have equity allocation, on South African equity performance, because a large portion of our funds are invested into South African equity managers. And again, just a snapshot of our managers in the portfolio that we have. And over time, we're very pleased that the managers that we have, the 4 managers that are in this, are ahead of the peer average as well, which means that our fund has done very well. Just of interest, you'll note that part of our South African equity exposure is in indexation funds, in Satrix. And you can see here that over this period, in fact, most of the peers actually underperformed the index because, in fact, the index has been particularly hard to outperform over this period. But notwithstanding that, I think the managers that we've got have come through for us. Great. So that's just a upshot of the historic performance and where we are at the moment. Just to know where we are taking the portfolios. And again, a lot of this comes down to how equity is allocated in our portfolios, especially in our more equity-centric and growth-type portfolios and our balanced portfolios. So this is the next slide is just an example of, or just to show you how the equity allocation, our balanced plus fund sits. Remember that this balanced plus fund is targeting to get a higher CPI plus type return in the ranges of CPI plus 6 or so. This chart is a little bit busy, but what we want to understand is how is our fund positioned versus the strategic asset allocation. And then also it's interesting to understand how it's positioned versus the other managers in the space. So within this fund, and again, depending on the aggressiveness of the portfolio, this picture will repeat itself across the other portfolios that are slightly less aggressive. But the Balanced Plus Fund equity allocation continues to remain high at around 73%. That's on the left there, and it's the big yellow bar on the far left, 73. If I contrast that to the yellow bar on the far right, that is the strategic asset allocation to the fund. That's the reference point with which we decide should we have more or less equities in our fund, because it's the strategic asset allocation on the right that we wanted to tilt around to achieve the long-term inflation plus returns that you've got. So at the moment, remember in this fund, we can't go more than 75% in equities anyway, so we're pretty full on equities, as is the benchmark, and we're at about 73% in equities. Just of interest, if we look at the other fund of funds in the space, which are direct competitors of Cinnabar, they've got slightly currently 69% in equities, global and local. The average manager, average unit trust, the ASISA peers, they're 67. And then the large manager, watch the big 7 pension fund managers in South Africa have 72%. So in fact, versus the unit trusts out there, we're slightly ahead in terms of equity versus our strategic benchmark. We're online, and which is also in line with the average pension fund in South Africa. But what's interesting for us is the makeup of that 73%, because our main tools that we have is obviously South African equity and offshore equity to make up that allocation. And you'll note that, again, if I look at the red is the South African equity allocation, and the gray is the offshore allocation. So at the moment, we've got 40.8, call it 41% in South African equities versus 32% in offshore equities. Now, that means if I look at the benchmark on the far right, our strategic asset allocation, our reference benchmark is 35% in South African equities and 38% offshore. So our strategic asset allocation says over time, we would expect to have more offshore equities in the portfolio than domestic equities. At the moment, that's in fact, we have the opposite. And at the moment, we actually have more in South African equities, 41 versus 33 in offshore equities. So the thought behind that process was twofold. The one is, as you're aware, we on a global equity perspective, think especially out of the US global equities, as Cameron has explained, or US equities, the index is quite expensive, but it's been held up by some very large, very expensive tech stocks. But the rest of the market is not so expensive. And globally, we actually think equities are attractive, notwithstanding the price of the big tech stocks. But funny enough, in South Africa, we think South African equities, while their earnings prospects might not be as great as say, US companies, our valuations are so incredibly cheap at the moment. And that talks to the fact that when you've got very cheap valuations, you do have the potential for more upside. And so we've had a slight tilt in the portfolios, this overweight to South African equities. And the other interplay that we've had, sorry, Cameron, if you can go back, the other interplay that you've got in your allocation of between local and global equities is also not just the valuations and prospects of South African equities or global equities, but where the currency plays. And we've been speaking about this for the last year. We over time have been wanting to lighten our exposure to South African equities, notwithstanding the valuations, the attractive valuations here, just because there are simply some great equities you can buy out of South Africa that you just can't get in South Africa. But the rand has been incredibly weak over this period. And so, sorry, Cameron, can you go back? So the rand has been incredibly weak over this period. And so therefore, we've taken a very considered approach over the last year of just incrementally lightening our South African equities in favor of global equities. And we're continuing that journey. And in the next 2 months, and that's played into our hands, fortunately, at 2 levels. The one is the rand has strengthened. So that has been a good decision. And the second one is South African equities have outperformed, and that's also been a good decision. But in the next few months, we will be taking another 2.5%, 3%, 4% off the South African market, selling recovering or rising South African equities and moving it into offshore equities in a strong rand environment, which is exactly what this slide speaks to. Perhaps then we can just go on to the global update, Cameron. So our global balanced fund of funds, so this is for offshore investments where the capital is already offshore, we're pleased to say is ahead again of its its benchmarks over the 1 and 3 years. But in a ranking versus its peers, you can see then that over 1 year and 5 years, it's still in the top 50%. And we're very comfortable with this performance. Again, it's just slow and steady to grind out the returns. And one of the key components in our global balance fund, as well as for our clients that are investing offshore, is the equity building block, or our global equity fund of funds. And the global equity fund of funds, as you know, we launched it in about 2 or 3 months ago. It was launched with $20 million in it. We are thrilled to have received over $31 million of inflows into this fund since its launch in July. And for those of you that understand the world of investing, when you've got a fund that has strong inflows, it's incredibly hard to track your benchmark or even beat your benchmark. And the reason why is if equities are rising, which they largely did from August over this period, is that if you get money in, you can't immediately press a button and have it invested into equities as the cash hits your desk. And so therefore you have a bit of a time lag between when the money hits you and when you can allocate it. And notwithstanding that, the fund has actually done very well. And we are 0.8% ahead of benchmark over this period from the launch. And so just hats off to Cameron and his team who have been able to implement these large cash flows and get it right. I think of more interest for our clients that are invested in this fund or invested in this fund via our other funds is just the makeup of the portfolio. So the big weight in this portfolio at the moment is, again, a World Tracker Fund, a Global Vanguard ETF. It just tracks the benchmark. And then we have active tilts, active manager selection around that for other managers that bring value to the party. And this is sort of a core satellite approach. It does 2 things. The one is this is also, it partly is around managing costs. It's also partly around having a core and not having too aggressive tilts around that. And so our view is that we'd rather have many smaller managers, each of them doing something unique or interesting in the space, bringing some value to the portfolio as our tilts against the benchmark. And we're very comfortable with the current positioning of the fund as these large cash flows have hit the fund. And bringing that all together, how does this result? This is a scatter plot. On the vertical axis, it's just the returns. On the horizontal axis, the risk or the volatility. How much do the returns jiggle around over time versus how much do they jiggle around? And it just scatters both our peers and where we sit. So 2 things. The one is it's important that we're actually achieving our absolute return targets, our inflation plus type return targets for each of our funds. Those are represented in the red dots. And then the gray dots or the black dots are the peer universe. Now, each, just in case there's a question later, each of our funds, for example, our income fund has a 1-year benchmark versus our longer term balance funds, which would have a 3 to 5 year benchmark. And so we've actually just made sure that there's a right measurement period for each of our funds. But what we're pleased to see again is that if you just get it slow and steady over time, not only does your risk return profile look correct in that your more capital preservation funds have less volatility, they do beat their inflation plus targets, And over the longer time frames, our more aggressive portfolios, our balanced plus funds, for example, has more volatility, but you are rewarded with a greater return for that, and you get that nice upward slope. And the cherry on the top then is that if we're getting it right versus the peers, those red dots rise slowly above the typical manager there. I just also want to highlight here just a thing around survivorship bias. We were talking yesterday among the team. So when we show performance to our clients, obviously we want to show performance versus the inflation plus target. You want to show performance against the strategic asset allocation. Are you adding value versus that? And then also you have to show performance versus the peers, because clients want to know how you're doing versus the peers. But one of the interesting phenomenons in statistically when you're measuring your peers is that bad managers go out of business, they lose clients, or they shut the funds down and they disappear. So what you actually find is over time, the average managers, the average performance of the managers, if you've got 20 unit trusts in your peer group this year, the bad ones disappear and their bad performance disappears out of the average. So if you look at the average unit trust return, for example, say equities over, if you looked at the last 3-year return, it might say it was 12%. If I look at that same number next year, it's going to say 13%, because the average of the bad managers have fallen out. And so the good managers, when they average the good managers, the performance rises. And so what you find is an historic rear view mirror looking approach, which is you're assessing your peers, is that the peers actually performance gets better statistically over time and gets harder to beat. And why I actually want to point this out today to you is there will be a time one day when we will lag behind the peers. And at that point, you don't want to say, oh, it's a statistical calculation and it's unfair because there's survivorship bias. So it's always nice to maybe point these things out when you're actually ahead and doing well. Doesn't sound like you've got sour grapes at some point in the time because the statistics argue with you in the future. And so I suppose with that little lecture, I'm going to hand back to Cameron, or to Alex, sorry, to Alex.
Thanks, Geoff. That was great to listen to. Mmusi, I'd like to welcome you. Thanks for joining us today. It's an absolute pleasure to have you with us. And I would argue that you're probably the star of the show. So with that said, I'm going to be switching off, putting myself on mute and listening and taking notes.
Thank you, Alex.
Yeah, thank you.
Can you hear me okay?
Perfectly. Yeah, absolutely perfectly.
Wonderful. And good morning, everybody. And it is my absolute privilege to be able to speak to you. I got a bit of slides envy as I was listening throughout the presentation. So I thought maybe I should have put out some slides, but I thought it is better for me to speak to you literally as a South African who is trying to do effectively what you are doing, which is to democratize access to opportunity for millions of South Africans. And I think there can be no noble a task greater than that. It genuinely, Alex, I appreciate you inviting me to come and speak to you. And what I will try and do is point a picture towards what South Africa's 5 to 10 years looks like. As much of the presentations that have happened prior looked a little bit about where we are, where we've come from. I think it's important that we don't lose track that our nation requires profound ambition to be able to traverse the next 5 to 10 years, which are going to be probably some of the most significant decade of our time, with the proliferation of technology, the change in geopolitics, and the change in certainly some of the domestic features of our political landscape. And so let me start there. Perhaps it may be helpful to give you a little bit of background from where I come from. I am a proud Sowetan. I grew up not too many streets away from where President Nelson Mandela spent some of his time in Soweto. I can remember growing up in the 80s as a child and seeing the duality of South Africa. You know, when you, at some level, you've grown up in the townships, there's so many beautiful things that occur in the townships. There's culture, there's music, there's great things. But equally so, growing up in the townships become this dormitory of unemployment in some ways. And, you know, like many South Africans, when the opportunities presented themselves, I was able to go to an ex-Model C school. When you arrive there, you suddenly interact with a bunch of white South Africans, and you start to think to yourself, hey, this is an interesting space. I can remember as a child having to learn how to use a fork and a knife, which was culturally something I wasn't used to coming from Soweto. We didn't use a fork and a knife. And then to realize the differences in approach. And then post leaving school, studying at the only relevant university in the country, which is Wits University. Anyone else from another university, I must upfront apologize that you got an inferior education. But be that as it may, you then engage a whole lot of South Africans from a politically charged universe. And then I got married to a young white South African, half Lebanese, half Welsh, which, to tell you the honest truth, means I live in fear. And so with that dynamic, I point that picture to you to say, I grew up in the politics of Soweto and followed the ANC, ended up being the leader of the opposition and followed DA politics, and now find myself again asking the question, how many South Africas do we live in, and how different each of those South Africas look like? In many ways, this is the perennial problem of South Africa. In some instances, I find if you are living in South Africa, call it that. You are seeing profound optimism. You are a celebrator of the GNU, because as previous presentations have indicated, of course, markets are responding positively to it. And of course, there are green shoots of hope and optimism. And the Springboks, they are playing incredibly well. But in another South Africa, and a South Africa I grew up in, which is that township South Africa, the lights have not stayed off for 200 days. In fact, most South Africans speak about load reduction, which is a phenomenon where effectively the government switches you off and they can't tell you. And when I met with Eskom, I asked them, what is the deal with load reduction? They said it's aging infrastructure in old township economies, and therefore ultimately their load shedding has continued. It's a South Africa where when I ask the statistician general, how much does it cost for a South African to survive every day? They tell me it's 60 Rand per day. And when I look at real numbers, you realize that over 18 million South Africans are living on 35 Rand a day. So for them, the conversation is vastly different relative to where you sit in this country. I get positive results about perhaps maybe I'm seeing a surge in the JSE. I'm also seeing a surge in unemployment and poverty and multidimensional poverty in another South Africa. I told Alex when we spoke a little bit about today that perhaps maybe when you live in the township, financial literacy is as relevant a conversation you would have from your parents as your conversation you have about sex, for argument's sake. I don't recall ever in my life my parents sitting me down and saying, well, what are you thinking about investment? Or what are you thinking about savings and all of the above? It was as foreign a conversation as that. And so what is the solve? And that is what I really want to anchor my conversation on, is that the solve for this country is that we need to figure out not only to have a government of national unity, but indeed an ambition that comes from national unity. A South Africa that works for all citizens. Because like I've just pointed to you, depending on which South Africa you live in is almost the absolute determinant of what education you'll get, what healthcare you'll get, what safety you'll get, and furthermore, determines what work opportunities you are exposed to. So with that organizing mission in place, I don't mean to damper anybody. I'm merely simply trying to highlight the fact that the project for the next 5-10 years has always been ever thus. How do we build one united, prosperous nation for all South Africans? And part of it is your job, and part of it is the job I get the privilege of being able to do as we focus on appropriations and where this country goes. The first is, you must understand that we've hit a maturity of nationalisms. What's great about this moment, politically anyways, is that I don't hype myself up about the GNU. What I do hype myself up about is the fact we have broken nationalism. The last 70 years of South Africa's governance framework has been on some nationalism of some kind or another. It's either been Afrikaner nationalism or it's been African nationalism. And so now suddenly today, we can have a better conversation about saying it's not black versus white. It's not African versus anyone else. It in fact becomes a conversation about how do we build a new sense of nationhood that isn't dependent on racial nationalism, as it were. So if you are like my father, in that generation, you've lived through both the nationalism of apartheid and the nationalism of the ANC. What you are now experiencing is suddenly a government that has a mixture of both those, but even more so in that it's introduced a diversity. That to me is a development that has come as a function of the government of national unity, but it is a defeat of, in some ways, and I don't mean this to sound like anti-ANC, I merely mean that the reduction of the ANC is an important thing. Because in truth, if you look at the African continent, you often find that many liberation movements arrive at this point where they feel they were the liberators of the people and therefore have a birthright to govern forever. So if you want to give a celebration for South Africa, is that despite its imperfections and its difficulty, we've had a fairly good transition of power. We've seen in municipalities, even though they may be chaotic. I know if you are in Joburg or Tshwane or all of that, I heard a conversation about Cilliers-Brink. But the truth is Cilliers-Brink is removed and there's no civil unrest that seeks to burn people. I might not support that decision, but I say that to mean our institutional framework remains in place and a defeat of nationalism is a positive thing. I think we also are, secondly, getting ourselves into a post-ideological universe. No one today sits around and simply advances notions like I'm a Marxist, a communist, a capitalist. I think each of those systems have faced their own strengths, but they've also faced their own challenges of credibility. You can look at China, and whilst it's governed by the Chinese Communist Party, I didn't make that mistake unintentionally, but in truth is, it operates as a capitalist society. And that's what's kept in many ways, when we have this conversation, China is a feature. You can look at many economies all over the world. We are in many ways in a post-ideological space, which is a great thing. It means that we have to answer questions about the future. And whilst, yes, half of the world's democracies have gone into elections this year, and many of the centrist organizations have in some ways done in a moderate sense. If you were to take the global caucus, as it were, more than half of it is still centrist and moderate. Yeah, there are certain countries that are swinging to the right, and I can see where the European Union sits, and many countries that are concerned when you look at the French elections with a swing towards right-wing populism. If you look at the Dutch elections, you can look at now the rise of the Alternative for Deutschland in Germany. So the political trends in Europe are still pointing towards the right. But if you were to take the global caucus, it sits within a centrist space, which gives me cause for comfort in the sense that at least there's still some rationality about how do we integrate societies all over the world. The third, which I think is the point that has been made, is that we are living in geopolitical reorientation. The sense of where BRICS sit and BRICS member countries and where that's going is an indicator of a new multipolar universe. I'm always careful to use that term because the first use of the term multipolar was young Adolf Hitler. So I'm very careful to try and draw on words that he would have used. But in essence, we are now starting to ask ourselves, the society, as Kwame Nkrumah argued so strongly, that we we don't look west or east, we look forward. There's a new geopolitical reorientation, which for us, as those who locate themselves in this continent as proud Africans realize that as there's now 1.2 billion people projected in this continent by 2040, imagine the opportunities that that presents. I would, if I was to bet, and I don't want to traverse into the space that you've already traversed in, if I were to bet, I think the next decade will be determined about what happens in this continent. More than, I get the point about the US, and I appreciate that when the US sneezes, the rest of us catch a cold. And I do appreciate what the EU does. But I do find that in some ways where this continent sits in terms of supply of labor, demand for infrastructure, the resource, minerals, Africa has an incredible story to tell going forward. And the Global South will determine part of what the new renegotiations will look like. So, and then the last is we're engaged in a new global climate change transition, which for South Africa, we have an opportunity to seize here. Much of our energy, and yes, the lights are on 200 days later, but there's no debate about the fact that 70% of that energy is still provided for by coal, which in an economy that's transitioning, we've got to think hard about what opportunities the just energy transition will mean. And so to answer the earlier question that was asked, do I think the GNU will work? There, in terms of two aspects, energy transition and in terms of logistics crisis, I think these are massive opportunities for the GNU to be able to fulfill. But the challenges still exist. The challenges of poor leadership, and I talk about Transnet as a point of interest, and an entity I've been watching with great care for. How is it that we have a logistics crisis, a leadership that was there in Portia and the CFO, and when they resign, having left an entity with profound wasteful and fruitless expenditure and high levels of corruption, they each get a significant bonus payout to leave the institution. I mean, it tells you that, in fact, we have a leadership crisis in the country in terms of being able to upend ethical, strong leadership. I met with the leadership of Eskom last week to look at how, in fact, they are managing, what not keeping the lights on, but managing their most crucial risk, which is Eskom's actual debt burden and what that risk means for the rest of the South African economy. So the first point that we've got to focus on, and we've got to ask ourselves better of, is are we still over the appropriate leadership threshold beyond sorting out the politics? And it's not just only in political leadership. It also must speak itself to what other dynamics of society there are. And this is going to be a very important question to answer. If we do not provide leadership across that is ethical, that is not corrupt, we then have a better way of chartering the next 5 years. We fail at that objective. I don't care whether you call it a GNU, whatever configuration you come up with, rest assured, we are going to deliver the same outcomes from a GDP growth point of view as we have for the last 10 years, which is just on average about 1%. So that's the first crucial question. The second is we've got to restore values in society. These are bridges. And so when I talk about whether we have a conversation of national unity or a national dialogue, part of what we've got to achieve is to bring the rich and the poor to sit around the same table and have a conversation about what South Africa do we all want to see. I am passionate about the eradication of poverty because I've seen it firsthand. I know what it's like to live in a shack. You have one fragrance and it's called paraffin. And those are what is now, statistically speaking, 55% of South Africans are living below the upper poverty line. A recent report says that just about 60% of households in South Africa at some point or another are becoming food insecure. So we have to ask that if we are going to have a national dialogue or a national unity government, we need a discussion between the rich and the poor. This is not to establish a class warfare, but is to restore our values that are placed in our constitution that simply say that we recognize that South Africa belongs to all, and that recognizing our historical injustices, we do everything we can to correct them. And I want to urge you, even for you as a firm, if I was to give you a call to action, we can't just have discussions just amongst ourselves. And I say this with respect. If you have a car and you have a house, you form part of the top part of South Africa. We've got to be willing to have conversations with South Africans that are not in that space. Because that is, if you create an island of wealth and a sea of poverty, you are going to create conditions of instability in this country over a long period of time. And so we've got to restore those values so that we don't talk about justice and all of those things as though these are conversations that are nebulous, but they become things that we really live through. The third, which is, I think, absolutely vital for this country, is we've got to remind ourselves, how do we build capability in the state? In many ways, we haven't built a government that works. We may have a political or reconfiguration that works, but we haven't built a capability in the state. And part of that speaks to the fact that if you and I were trying to go to a public healthcare facility, there's a strong prospect in certain instances that you may not be able to see a doctor in time, all of those things. It's all differentiated across various provinces, but we've got to build capability. You know, all of us can celebrate some reforms that are happening at Home Affairs that adjudicate visas and all of that. But when you look at policing, as an example, the ratio of police to citizen for international benchmarking, it's 1:350. So one policeman to 350 citizens there and thereabouts. In other communities, this issue can sit at 1:1,200. So if we want to build efficacy in the state, we've got to come back to a point where we say, actually, the basics for all citizens must be acceptable. If you go to one school, quintile 1, 2, and 3 schools, which are some of the poorest schools in the country, you find yourself in a classroom of 70 learners. If you go to quintile 4, 5, then you find yourself, the classroom size is reduced, the quality of teaching improves, and technology is there. Gauteng schools at this point in time, 94% of them are still without internet. So let's build capability in the state. Let's, as I read a report yesterday that got me slightly worried, that 4 out of 5 bridges in Johannesburg are not safe. So to my fellow friends in Joburg, I want to wish you well on those roads. You will soon wish for broken traffic lights if we fix nothing about the bridges. So this is about capability. It's about not having a revolving door in the mayoralty of Joburg. The second is, I do agree with you that our economy is showing some incredible resilience and signs. Our economy often reminds me of what Jan Smuts said. South Africa is a place where the worst never happens and the best is almost near impossible. We have to, along with the new green shoots, now push the accelerator button. Ask the brave questions. Next week, on Wednesday, the finance minister will table the midterm budget policy statement. My anticipation, and I'm not a prophet, I'm just merely looking at certain things, is that you may very well see an increase in the social relief distress grant. You may very well see certain aspects of projections. We're starting to feel that there can be potentially an increase in our own GDP growth, whilst nominal from 1% to maybe projected, we might tick over the 2% bar come the end of next year. And history has indicated the fact that business confidence and political reform are often linked. So part of the change in the GNU has been a function of a decreasing business confidence over the period you described last year. It forces political change. And now what we've got to do is maximize that, given the fact that now we're starting to see some green shoots of confidence as people are going through. Along with next week's budget, we will see an increasing toll potentially in the debt to GDP ratio. So that will start to go up, because South Africa, if historical growth is an indicator of anything, it tells us the fact that we simply don't have enough money to meet much of our objectives operationally. The great pain that we face is that we will spend more money on debt servicing costs than we will on other services, i.e. policing, education, etc., etc. So this is the headache that any finance minister, any government, certainly in South Africa, has faced up with. And ultimately, that headache will deliver in whether or not we're able to invest in sustainable infrastructure. Along with that, I want to say that this is where your job is. As you lead, I often am critical of business, so I won't be today. I always say, business has never found a government it does not like. So when I hear I want to tell you, keep going, but keep going to lead the conversation about reforms. Keep leading conversations about infrastructure. Keep holding political leadership accountable. Keep asking the hard questions. We cannot just be like kumbayaring our way through this, because the decisions we have to make as a government are incredibly hard and are absolutely important. From a future point of view, I do think, as I've highlighted earlier, being part of Africa, being part of the geopolitical arrangement, what gives us an opportunity in South Africa is that it's not coincidental that by a divine miracle, we were placed in between two oceans, which means the US has an interest in us, and so do the Chinese have an interest in us. But it also means we can create new pathways. If the war in the Middle East continues, which it seems like it will be for a while, we can create new pathways for movement of goods all over the world. This I think is something that we've got to seize as an opportunity. We've got to think of ourselves as genuinely that network globally, build better ambition to say, could South Africa become a dominant player in Africa? And by extension, we will put that into the rest of the world. We have some amazing opportunities. We've got to lead in regional politics. We can't accept democracy to fail. We've got to lead through that as South Africa. And yes, people have spoken about policy confusions within the GNU. I wouldn't lose sleep over that, because to tell you the truth, those issues are going to be railroaded in some ways by ANC policy. So I'm not too worried about that. But what I am worried about, if you were to say to me, what keeps me awake at night? What keeps me awake at night is that you can have a piecemeal approach to everything, but some things cannot cope with piecemeal. You can't remain neutral forever. You have to seize the opportunities, and seizing opportunities means someone has to be annoyed and you have to drive the change as best as you can. We have to not kowtow to unions on education. We have to pick our learners and produce the best skilled labor possible. We can't, in the interest of keeping Eskom executives happy, allow municipalities to fail to pay them. We have to force that. If you don't pay, we switch you off, which is the painful thing that we've got to do. And more than anything, we've got to make it easy for capital to flow in many communities. So let me wrap this up by this way. The Kenyans say it best. They say, at first we must be liberated, and then we must liberate ourselves from the liberators. Which means this moment requires South Africa to charter a new form of governance, not just by solving the politics. This is about how we inherently govern. This is about how we elect our leaders. I've been advancing the question that says, actually, let's get people to vote directly for the president. And as I close, I think if we treat this moment correctly, a little bit similar to what 94 looked like, we could charter some new, incredible changes that can deliver a future for this country that all of us can prosper through. So I am confident, I am optimistic, I'm looking forward to it, and I look forward to taking questions from you. Thank you very much. Thanks, Alex.
Mmusi, that was a great introduction to what I think is going to be a barrage of questions coming your way. So I'm going to hand over to Zahid and to take us into it.
Yeah, Mmusi, that was a very inspirational session. Just amazing that the different insights that you are able to provide in this, obviously with the insights that you have with the GNU. So I'm going to start with a simple question. What key risks do you see in SA for 2025?
Do you want me to answer each one, or do you want to take a few?
I'd rather you answer each one.
Okay. Look, heading towards 2025, the first risk is the ANC's elective conference will start to boil up, which means that the stability of government, as President Ramaphosa himself, it may not be seeking a third term within the ANC. It means that the ANC itself, as a big block of the GNU, will start to think about something else. Politicians, sadly, can't do two things at once. They can't govern and campaign. They'll do one of them. So in all reality, that is the one risk. But economically, I think that if we don't see the dividend of an uptick in levels of employment, what that does is that it emboldens political opportunists, a bit like MK, to begin to say, let's rally up and ratchet up the thing. Because here's the dilemma that we face. Whilst we celebrate an easing up of inflation, what is going to be an input cost going into that is that Eskom have already required a 36% increase. They will be granted that. I suspect in the midst of that, once municipalities add their tariffs onto that, that moves it to about 38 or 40% in that regard, depending on the nature and size of the municipality. With that input cost, just that inflationary pressure alone, it means that you've got conditions for the 60% of South Africans are speaking about, where A, they either switch themselves off, or secondly, what they will then generally tend to do is to demand services and force themselves to say government must do something. So there is a fiscal risk that must be baked into that, and especially with a government that doesn't have enough wiggle room or flexibility to be able to purchase some of the easier gains. And you can only do so much on grants. You can only do so much on easing the burden on consumers. But I think Eskom's risk, as far as input cost of energy, as it speaks to MK and parties like that, and then obviously the stability of the GNU, as it speaks to President Ramaphosa and his own future within that. The opportunity, of course, is that we chair the G20 summit, so that might give us an opportunity to focus on that next year. But I can tell you, as the second half of next year rolls on, the ANC's conference bell will start ringing, and that will be an interesting space.
Yeah. Okay. Mmusi, I'd be interested to hear. So obviously, there's a massive case for renewable energy. Like coal isn't enough to if we wanted to have this full-on transition. Is there conversation, maybe your opinion as well, on the use of nuclear energy as a power supply? Kind of just an issue to bridge the gap. I know it's obviously had a lot of negative connotations, nuclear energy, but the case now, and a lot of the bigger countries are starting to adopt it now. Is there a case for nuclear energy? Maybe if you know how the government's feeling about that as well, be interesting.
Yeah, certainly. I sit on the portfolio committee on energy, and that has been a conversation that has been had. In terms of where the dilemma with nuclear is the question of infrastructure build and the cost thereof. So it's well, fine and dandy to have an intention around nuclear, but the only way you can do that is if you can create really genuine public-private partnerships so that you can have outside investors being looking at plants. The state simply doesn't have capability to be building certainly bulk infrastructure of that nature, and certainly Eskom doesn't have the reputable balance sheet to be able to borrow against its own balance sheet to create new nuclear. So there is a conversation about that. But in the splitting of Eskom, which has already happened to some extent, now you've got a fairly robust distribution space and a generation capacity space that's starting to emerge. What I think is going to happen is that the distribution one, as it eases up licenses, will make it possible for a nuclear player to come on board. But certainly the conversation is being had. You can't get away from it.
All right. Very, very interesting.
Okay. Mmusi, we've got a question from one of our audience members. Can you provide some insight into what plans the GNU has for youth unemployment?
It's a good question. Because I've got to be careful how we position this. My frustration at the moment is that the plan is, let's keep doing what we have been doing, only better. And I'm not sure the pain about government, and this is what sometimes, I don't want to sound negative, but the pain about government is that it doesn't always have an ability to make the tough decisions that would favor young people. For example, so let me give you a practical statistic. One of the things that government seeks to do is that it uses its procurement spend to achieve empowerment of entities, particularly youth-owned entities, as an example. So So Q2, which is the quarter we've just come out of, going into, sorry, on the spend that we put together for youth-empowered organizations, that represented less than 20% of businesses that we procured from in that regard. And that is consistent for Black-owned businesses, consistent for women-owned businesses. It's worse for people with disabilities. That number sits at less than 1%. So even in the state's ability to use its own procurement of stimulating youth-owned businesses, it can't always procure from them fast enough, and that's on one space. The second is the employment tax incentive is a crucial intervention as it links to the YES program, etc. But it simply is not enough to roll out the numbers that you need for young people. Seriously, you must be grateful I don't run the state to its fullest capability, but I would have by now forced every employer in this country to say, in exchange, we'll give you a tax incentive if you hire an X amount of young people, because we need them in productive spaces rather than not. And there isn't, because we are so fiscally constrained, it's sometimes always difficult to give tax incentives with these. And then the last is generally the universal thinking around this issue is that let's roll out the community workers programs, so CWPs, and public works programs. And that seems to be attractive to young people, but it's piecemeal. And I'm not sure it is skilling of young people, because there can be only so many roads to sweep, only so many light bulbs to fix. We actually need young people to be in other productive spaces so that we can do that. So my sense, and this is a policy advancement I've been trying to go forwards, is that we need a national civilian service, give young people a one-year program of which is mandated for them to be able to come through, so that they can begin to say, let's give them some work experience for a year, 6 months of internship, 6 months of actual work in other spaces. They can intern in public institutions and private institutions. So we'll give you the tax for it, but it will force a rollout of a year where young people are productively employed. So,
yeah, I mean, it's so important. I've kind of seen how a lot of my friends that I went to school with, that I studied with, how as soon as they got into the work industry, there wasn't opportunities for them, and they've all had to leave the country. And I think that's such a sad fact. There's such a brain drain that's been happening, that now for me to be one of the few ones left here, I'm almost the odd one out. So there needs to be massive structural reforms from the government level to kind of feed down and benefit people. I mean, I came from a place of privilege, but the rest of the economy, I mean, I'm the minority in that sense. There needs to be changes happening there to help the economy grow. So no, I completely agree with you there. I'll also ask the next one, because I see there's quite a few coming through related to kind of like the NHI. Obviously, we know their view, but I think it's quite topical for a lot of us here. Kind of the impact that the GNU is going to have on the way forward for the NHI bill, and then if it even looks like it's going to be implemented. Kind of your thoughts on that one.
Again, let me put the ANC's elective conference on the table. There is no president who's going to arrive at the ANC's elective conference and say, we resolve to implement the national health insurance. I did not do it. Please elect me again. It simply is, that story doesn't win you votes, certainly within the ANC's conference, right? So I certainly think that there is, even just from a survival point of view, or it's not even on the person of President Ramaphosa, it's the group of people that are surrounded with him. There is an altruistic sense or survivalist sense that says they must force through the implementation of NHI. The difficulty is that it is unaffordable. The state simply doesn't have capability to be able to do that. And also an attraction of, in certain instances, private medical aid holders, who many of them are aging, to try and introduce them into the public service system is going to be hard. What models are being tried at the moment is to create the state as, if you like, an insurer, and then secondly, to be able to free up assets so that you as a medical aid holder, if you want, for example, and I'd still say this to you, if you're a medical aid holder and you want to get the best liver specialist, I promise you, do not go to private. Go to Groote Schuur. That's where the best are. Go there. And it's a public institution. The problem with that is that we haven't worked out the appropriate model for your medical aid to be able to pay a public institution. So that work must be done. But if I was looking for other services, for example, some of the best specialists in the country are in Baragwanath Hospital. You wouldn't know that if you think maybe Netcare or whatever. If I was in a car crash, please do take me to Bara. Because there are some incredible specialists there. So we got to figure out a way at which you can be able to pay for that services. But more than anything, along with financing it in that way, the financial model is still being implemented. I think it is something they'll kick down the can for a few years. There is just no ways at this point in time in the short term, or at least in the medium term budget framework, that you can implement NHI at the state that it is. So at least I would say for the next 3 or 4 years, I won't see NHI in its full implementation, and there are clauses that simply make it unaffordable. So it's not going to happen from that perspective.
Yeah.
Sure. So you chair the appropriation committee. It's probably, I think it's probably one of the most important roles within that you could have taken on. And obviously you get to see how public spending actually happens. And I would imagine most of your attention's given to large spends like Eskom, Transnet, municipality. Do you get involved with in more minutia, where it gets down to sort of where the capital's actually going? Because it feels like there's still an incredible amount of corruption happening in Gauteng. And Gauteng's a breadbasket for the country. If we don't fix Gauteng, I think the entire country remains in a mess. If you look at tax returns, Gauteng, although it's a very, very small province geographically, it's where the majority of state revenue gets funded from. So how do we fix that? How granular do you get? And what have you noticed over the past few months since you've been in office?
So it's one I don't want to, I mean, you know, we have oversight over 2.1 trillion rand, of which is split between national and provincial allocations. And keeping up with corruption just only at state-owned companies is enough to keep me significantly busy over a long period of time. But the difficulty is that where we can be able to deal with provincial entities is I have a fairly strong working relationship with Tsakani Maluleke, who is the Auditor General of South Africa. And ultimately the AG, for example, I was with them, what's today? Thursday, so I was with them on Tuesday. They came and they'll give me a sense as to where each entity or which province is at. And if there's a demand for information, I can ask for the audit opinion of Joburg, as an example. I can ask for the audit opinion of the Gauteng Health, because any institution that receives public money, we have oversight thereof, and therefore ultimately needs to hold accountable. I'm also very careful. There is another standing committee that deals with public accounts. So SCOPA, which is chaired by someone else, they look at all the corruption that occurs. My job, in essence, I try and frame it in this way, is that whilst I accept that there may be corruption in instances. So for example, one of the things we've spent the last week or so is in partnership with the SIU looking at where the Gauteng health budget has been diverted. And that's through medical legal claims. That's what's happened at the Road Accident Fund in many ways. So there is some of that work, but I'm also conscious of the fact that I don't want to invest all of my time on corruption and miss the performance indicators. And the performance indicators are often such that, to use education, which 10% of the education budget is national, 90% of it is provincial, I have to answer the question, actually, if there are 100 kids that start school, how many of them actually get to the end, and where's the money going that stops them from doing that? And when we work out that 60 of them will get to matric and 40 will drop out before that, that is more livelier discussion to have than actually where the feeding program in a school that was corrupt, how do we attend to that? That I kind of hand over to other committees. So I've really tried to, and I say this to disappoint you, Alex, to say, in some ways, part of what the last 5 years, or maybe the 6th administration, we became, as a country, obsessed with corruption, state capture, and sometimes neglected some of the performance issues that we have to ask from departments. And I'm trying to reinculcate that, to say, actually, you may not be corrupt, But if we give you 100 rands to spend on X, on policing or whatever, why are we not achieving that? What stops you from saying, if we gave you 100 rands to build roads and you only build 2 roads, what went wrong? So these are some of the things that I'm wanting to spend the next 5 years really spending the majority of my time on. That's not to ignore corruption, but it's to actually say, what are the performance indicators that we need?
I quite like that concept. I mean, if you, in a way, you're trying to live in the gain, not the gap. So, yeah, look at the gains that needs to be made. I mean, a similar fashion, we're trying to take financial freedom towards children, because if we can get financial freedom concepts into kids from grade 11 and grade 12, and they go into the workplace with financial freedom concepts, where they start doing the right things with regards to money as soon as they start earning their first cent. I think the next 20 years will probably be grand. And if we can get teachers to also start living with the right financial behaviors, and they're teaching our kids the right financial behaviors rather than going out and buying those fancy cards that they are on credit, then I think that the next 20 years would also be grand. So I think we've all got to play a role. It was actually one of the questions in the chat is, as small business, what role can we play? We play to foster the growth of the country.
I mean, you know, I always say, and I don't want to, particularly in this investment front, particularly as SMMEs, I think we can't just. So let me use a terrible example, and I'm very careful not to go into this because I don't have the figures off the top of my head. But if I buy any insurance policy, any kind, and I put through a debit order of 100 rands through Capitec, the charge that Capitec put on that is 11 cents, which in essence means I'm being at a premium of 11% of the transaction I put on the table. Now, would any of you accept an investment that had an 11% charge already linked to it as a start, without any additional fees onto it? So I say that to mean, when we have a conversation about, let alone, I know you are not a product business. You are a business that, if I remember your mission statement, is how do we help more people become more millionaires? That's a great ambition to put on the table. If you think about South Africa in total and say, like Uber, how do we make sure Uber works in Sandton and in Soweto? What are the risks that are there, and how can we make sure it's all standardized? So whatever rates we put on the table, how do we democratize access? How do we get more people? That gives small businesses an opportunity to be able to engage. Life cover sold in the townships is more expensive than anywhere else. My bank gives me incentives that are insane. I can afford a cup of coffee. I genuinely can. But they give it to me for free, and they work out other things to give me for free. And I get that. But I wish they'd give that to my mother, because she needs them more than me. That's just because her bank balance doesn't look. So I want to invite us to a mission of South Africa in total, rather than South Africa in parts. And so whatever business, even if it's a small business, ask yourself, how do I get this business into the township? Because if you can do that, then you are starting to really move the needle in South Africa. If it just only operates for a few, it genuinely perpetuates the sense of South Africa A and South Africa B, and it's unsustainable. There is profound wealth at the bottom of the pyramid, as Indian economists have worked out. So let's figure out, how do we maximize that? And that is an important role you can play. And in financial literacy and education, to your point, ultimately, know this, I tell you this, as I said in my opening remark, my parents didn't talk to me about this. And so if FNB did anything to keep me as their client for as long as they have, is that they came to the townships in the 80s and introduced Bob T. If you can remember Bob T account, you are vulnerable.
It was my first account as well.
Yes, so which means you and I are both vulnerable to COVID. If anything happens, we mustn't go out. But the thing is, they got me into some form of banking, helped me become bank, and began to get me into the system. But not enough of that is being done on financial instruments. and we've got to figure out how to do that.
Yeah, I think there are quite a few organizations that are quite predatory as well.
Yeah.
The number of individuals we come across who have 3 or 4 different funeral covers, and are using funeral cover as an intergenerational wealth tool, and it is one of the most expensive life covers that you can get. So it's making people poor rather than adding to their wealth. Sorry, Zahid, I'm busy interrupting you. I'm sure there are lots more questions that are in the pipeline.
Yeah, no worry, Alex. So we got a question from Bernard, and he's asked, why has the GNU not filtered down to provincial and municipal levels as yet? I mean, Gauteng seems to be the maverick in this concern, but why is it not actively filtered down to the other levels of government?
Because firstly, there's a structural problem in how we run elections, right? Our elections are not synchronized, which means you might have an agreement at local government level that started in 2020. The last local government elections were in 2021, and then in 2024, you've got a different configuration at national. So there's a structural issue about synchronizing elections. I am one of those who says we must synchronize them, and if it becomes confusing for Almal, that's a better risk than trying to spend money running an election every 2 to 3 years, because it means even the president, as soon as they come into office, they're starting to think about local government elections instead of doing actual work for the next 5 years. So there's a structural problem with that. The second is, I think that Gauteng isn't just necessarily a maverick in this regard. I think that, and I got to be careful how I say this because I don't want to temper down enthusiasm on this issue. It's that there's still in certain corners of this country skepticism about certainly the relationship between the ANC and the DA. And so depending on which side of that fence you sit on, you may not necessarily want it at your local municipality because you've seen other problems. So if you are in fact, as an example, there are a lot of municipalities in the Western Cape, the rural ones, that are starting to reconfigure their ways. So there's a skepticism about that relationship. And part of it is also a skepticism about race relations in this country, right? Because where previously in the Rainbow Nation euphoria, we were like blacks and whites can work together. I think there's a whole bunch of South Africans are starting to think about this issue in a totally different light. They're starting to go, can we really trust that the DA's interests will be aligned to black South Africans' interests in any other way? So there are still some of those challenges. But I would urge quite critically that whilst all this moment is a moment of transition, let's not treat it as a permanent feature. We are still going to see new reconfigurations. We're going to see new players move. You might have seen Floyd move to MK, or yes, from EFF to that. You'll probably see some people move to the ANC. You'll probably see some DA people move. So all of these movements are still going to happen. I think when we amend the electoral law, the offering we'll put to voters in 2029 will be vastly different, which will make it easier to have any national coalition agreements filter across all levels of government.
Yeah. All right. I know we've got quite a few questions here. So I think we're going to leave the investors questions. I think the Cinnabar team will answer that directly. Which I think it's probably best while we got you on the call just to answer maybe some of the other questions. Let me just scroll through here. Here's one. What do you see the role of financial advisors and firms alike playing in building of South Africa and empowerment of the upcoming generation? So what role do you see them playing?
Sorry, which South Africans?
Financial advisors.
Look, I mean, I think what I was really trying to give you a sense of mission of is that let's think about the financial landscape of South Africa, not only from the lens of those who work, but think about it from the lens of all South Africans. So let me give you an example. A number of years ago, I was involved in a private equity kind of conversation, and we were looking at investing in certain things. And someone had worked out how you can create a financial product that would help someone who lives in a shack be able to insure some of their assets. Now, the one asset you have in a shack, like if you have a shack fire, the one asset you look after the most is your fridge, because often that's the thing that doesn't burn in a fire, But if you go after a shack fire, you almost see the devastation of it, with people sitting next to their fridges, almost in some ways to mark the territory and to rebuild from there. Now, I often wonder, if you were to, because people who live in shacks aren't just unemployed. There's some income that occurs there. There's some grant income that goes in there. There's some pension income that goes in there. But also there's underemployment. People often live in shacks closer to work opportunities because it's cheaper from a transport point of view. So if you can't travel, if you can't use 40% of your income for travel, you can rather live in a shack close to your workspace, which reduces that and gives you more liquidity. Now, why can't we think of products that help that citizen? Why can't we empower that citizen? Or at least, if you ask to say, what's the median wage in this country? The median wage in this country sits just over, I think it's just under 4,000 Rand, just about. It sits somewhere there. Let's really be imaginative about how we can help those citizens plan better for their financial sustainability over a long run, without, to Alex's point, the predatory behavior, but to that ideals of saying, let's help these citizens. I am pained at this because when I think about my father is smarter than me. Apartheid meant he couldn't go to school. But I'll never forget, and this still dawns on me, and that's why I say this to you with passion more than ration. When I went to go get my father's pension from his employer, he sent me there because he said, you are young, you know how the banking system works, help me reinvest this. I promise you, after what was then 30 years of work to this one company, his cumulative pension was half or a third of what I was making in a year. Now that's insane. Honestly, that is insane.
Yeah.
So if you can help, let's fix for those kinds of things, because they perpetuate profound inequality in our society.
Yeah. And Mmusi, I agree with you so wholeheartedly. And that's one of the reasons why as WealthFit, so our technology solution business, have implemented something called the Financial Freedom Program. And that it really looks to solve two very, very big problems. The first one is financial literacy. And then the second one is giving someone a person to turn to, because most people, they are so lost financially, whether they're earning a lot of money or a little bit of money, but they have no one to turn to. They can't turn to their employer, they can't turn to their spouse, they have no one to turn to. So we've implemented this program, and the whole idea behind the program is that anyone with a job, anyone who's employed, can get to financial freedom within 240 months. Maximum. They can, in other words, they can, if they start work at age 20, by age 40, they can stop working if they want to. They will have enough by following the right principles. But too often we see people make unforced errors in their finances, and the unforced errors they don't even know they're making half the time. And the most common one when we come to pension fund members is they under-risk their portfolios. They put their portfolios into a return which is guaranteed to be very, very steady, but low, rather than going into a portfolio which won't be as steady, but over time becomes very steady and higher. And that one decision often costs people their retirements. It costs them a happy retirement. And a lot of the life insurance businesses, they've preyed on this and they've put guarantees in place. So they've preyed on people's fear of loss, and they put guaranteed products in place, which, yes, they produce a certain return, but it's a lot lower than it would have been had they taken a longer term view. And that actually hands us quite nicely over to the last slide that I'd just like to share with everyone. And this is really about how to meet goals, meet goals, and it boils down to this new picture which I'm going to share with you, and that is this funnel of certainty. And this funnel of certainty looks at a range of different portfolios. I know it looks confusing right now, but there are effectively, in this chart, there are 4 different portfolios: an aggressive portfolio, a moderate portfolio, a moderate conservative, and a conservative. And you can see the more aggressive the portfolio, the wider the range of potential returns in 1 year. The more conservative the portfolio, the narrower the range of potential returns in 1 year. So in the first year, your range of returns is very, very wide, from sort of -45 to +95% on your most aggressive portfolio. As time goes on, though, things become more and more predictable until eventually your range of returns becomes very, very predictable, and it starts tracking to whatever your asset allocation dictates that you're going to achieve is. So what we see a lot of people do is they go into a very conservative portfolio, which over a long time is going to be targeting a CPI plus 1% return, which for most people is not going to help you achieve financial freedom. And what most of us should be in up until virtually the end of our working career, if not beyond it, is a return where we're targeting CPI plus 4, CPI plus 5. And it is very uncomfortable over 1 year. It can be uncomfortable over 3 years, but over a fair length of time, the length of time that most of us hold our investments for, it becomes very, very, very predictable. So I'm going to wrap up there, and I'm going to, Mmusi, I'd like to thank you so much for joining us. To have you with us was an absolute pleasure. I don't know where, there you go, you're on now. It was an absolute pleasure having you with us. It's a privilege to hear your thoughts. You inspire a lot of us, and I wish you a lot of strength in your career, because I think if you have a strong career, I think it's going to help many of us as well.
Thank you so much. It's my great privilege. I really appreciate it. Thank you.
Yeah. Well done to the team. I think you put together an incredible quarterly presentation. And thank you again to all of our guests for joining us. The YouTube will be saved probably by the end of today. So if you would like to share it with others, please feel free to. And we really look forward to having you join our next session, which will it be early January or February?
I think we'll probably do it either towards the end of January or early Feb. It's not locked in.
Okay.
Yeah.
In that case, I wish everyone a good festive season. It's not quite upon us yet, but I can feel it's starting to gain momentum. So have a good festive season and be safe. And we'll see you next year. Yeah. Cheers for now.
Cheers.